Hey, Carl Spiteri at Benchmark Mortgage. Hope you're having a great day. Just thought I'd talk a little bit about the home equity line of credit, which seems to be very, very popular in today's world. And I'm going to compare it to the home equity conversion mortgage. Heloc, Hecm are the two ways we refer to them. And this is part of the Retirement Mortgage Solution series. When we look at a line of credit, what do we get a line of credit for normally, right? And that would to have it there just in case, right? So we're in our retirement years. We kind of just want to kind of the safety valve should things come up that we're not prepared for. The challenge with the line of credit is if the economy takes a downturn, they can be turned off, which means they don't say you immediately owe the money you owe. However, they'll turn off any unused portion line of credit. If you have $100,000 in a line of credit and it's your emergency line and you owe zero on it, the economy takes a downturn or housing takes a downturn. I'm not saying that's going to happen, but if it did, they could actually turn off that line of credit and make it zero. If you had a balance, they'd allow you to continue making payments on it, but they would not allow you to take any more money. The other challenge with a traditional line of credit, it has 2 5-year draw period, which means you can take money from the line of credit anytime you wish up to the approved amount for up to 10 years. You make interest-only payments on that money, and after 10 years, it rolls into a 20-year adjustable rate. It's an adjustable rate during the whole time. However, it rolls over to a 20-year adjustable rate with principal and interest payments. It's reusable. However, it has no growth. It's just if you get a $100,000 line of credit, it stays a $100,000 line of credit for as long as you have it. When we speak about the retirement mortgage solution, one of the tools that we use is something called the Hecm, the home equity conversion mortgage. That is a credit line for the life of the loan. It grows on a yearly basis. So if your interest rate is at 5%, your equity line is growing by 5% plus a half each year. It's reusable as many times you want it. You want to use it. It can never be taken from you. I shouldn't say never, up to the age of 150. It has no balloon payments, no term limits. So it's there whenever you need it. With the key is growth. And that's one of the things I like best about it because we all know inflation has taken a real toll on us in today's economy. If you need some money, it's important to know that you're not drawing down your line to zero because you're going to get a little bit of growth each year. So something that I want you to look at is comparing the traditional line of credit versus the Hecm. You retain ownership to the house in neither scenario. The line of credit or the Hecm, the house is yours. Just because you're getting a reverse mortgage does not mean you're losing control of your home. You make monthly payments on a traditional line of credit. You do not on a home equity conversion mortgage unless you want to. You're allowed to make payments if you want to. You just don't have to. If you make payments, the money you put back into it goes into your line of credit, makes that grow and continues the growth. We know that a Heloc does not grow over time, where a Hecm does grow over time. The Heloc can be closed by the lender at any time they choose to, where the Hecm is a government-insured line of credit that cannot be closed. You never owe more than the house is worth. With the traditional line of credit, you can. With a home equity conversion mortgage, you cannot. And the risk of foreclosure, it's pretty hard to get a reverse mortgage foreclosed on. I mean, it would have to come from the tax authority or the city, basically, because you don't have payments on the reverse mortgage. So when you're looking at risk of foreclosure, the line of credit, yes. The Hecm, we say no. I just want to show you a chart here. So it's what's the cost of waiting? So you say, well, I have no mortgage on my home. Maybe I'll do it 5 years from now or 10 years from now. What I want you to show you is the growth. If you have a expected rate of 4.35%, which is a little low for this economy right now, but it's a little high for an economy that was a couple of years ago. So we're just using this as an example. At age 62, with a home, you would be entitled to a $178,000 line of credit. That credit line will grow to $277,000 in 10 years and $431,000 in 20 years. Where if you started the line of credit at age 72, you start off with $200,000, but it only grows to $311,000. So as you can see, there's a difference, and waiting can cost you. Most of the time, we issue these Hecm loans. I shouldn't say most of the time, but some of the time, with homes with no mortgage on them, and we're using it as that just in case. What if we need major home health care? What if we have something really unexpected with the home, or, once we're on fixed income, it's hard to get extra cash without taking out of retirement accounts, which of course triggers tax consequences. This is home equity, which is not taxed. So there's a couple of different benefits here that I want you to kind of think of. And again, we're open to meeting with you at any time and talking through all the pros and cons. I just want to show this last slide here with, the question I get a lot of time is, well, my inheritance is going to go away. I want to leave my house to my children or to a charitable organization. Well, as you can see, your house doesn't stop growing just because you have a reverse mortgage. This line in blue shows an appreciation rate and what it's going to be 10 years, 20 years, 30 years from now. It also shows what your loan balance is going to do if you continue to make no payments. And this is starting off at $200,000. It's going to grow to over $600,000. However, your home is growing as well. And again, this is just for illustration purposes, but it also shows how your line of credit can grow. So what I would like for you to do is I'd like you to reach out to me. Give me a call. Let's schedule some time, either in person, through Zoom, by phone, whatever works for you. And let's see if we can have this make sense for you. We want you to understand this product. We want you to utilize it if it's in your best interest. And we'd love to have a conversation. Here's my contact information, and I look forward to speaking with you. Have a great day.